Guys, we just have a quick question here from Charles. Charles is saying that he doesn't have access to something like the S&P 500 through his broker, and he wants to know whether he can trade the euro yen as an alternative because they do seem to be correlated with each other. So thanks for the question, Charles. And it is true that most of the yen pairs are correlated to equities. Some of them actually a lot more than others. Even though the euro yen is normally correlated due to the safe haven aspect of the Japanese yen, there are some currency pairs like the Aussie yen, for example, which is considered by many as a favorite risk proxy, probably the favorite one among the FX space, because the Aussie dollar is, of course, considered a high beta currency, just like the CAD and the Kiwi, but it is oftentimes more sensitive to the health of the global economy because it's got a bigger or larger exposure to China, and China, obviously, the second largest GDP contributor on the global scale and the biggest export destination for Australia. And they also have a lot of exposure to commodities. So, the Aussie normally captures a lot of that high beta, whether it's from the global health side, whether it's from the commodity side, and oftentimes Aussie yen considered then as a favorite proxy for risk sentiment. But even though that is the case for something like the Aussie yen, that correlation doesn't always hold true. And even though many of the same things that influence currencies also influence other markets like equities and bonds and commodities, there are differences in the way that these markets sometimes react and the main drivers that they focus on at any given time. So, for example, when you take a look at equities, let me just get this on the screen for you. Even though there are many things to consider, the biggest three drivers, in our opinion, to always look for equity. So, let's say you're trading the S&P 500, for example. The first one would be that particular country, the growth and inflation, the rate of change in growth and inflation, and how that translates into policy decisions for the central bank. The second one is overall risk sentiment. And the third one is cyclicality. Now, for more info on that, we actually did a video on equities specifically a little while ago. So if you go to the terminal in the video library, let me just go through those steps. So open up the video library, go to your Q&A section, and in there, just look for the one called Key Components to Track for Equity Markets. That goes through a lot of detail and a few other nuggets as well to consider. So just catch that one. So, even though the yen pairs are correlated to equities, like we said, some of them are more correlated than others, which means that the Aussie yen would probably be a better play compared to something like the euro yen. But even then, you won't really be comparing apples to apples. And the reason for that is because with a currency pair, you have a lot more variables to consider, or other variables rather to consider. You don't have to track one central bank. You have to track two central banks. You don't have to track one country's economic data. You need to track two, not one country's idiosyncratic drivers, but two of them. You also have to contend with things like positioning for both of the currencies, the implied volatility outlook for both of them. So all of that doesn't mean that it's easier to trade equities compared to currency pairs, but it does mean that substituting one as a like for like alternative for something like an equity index can be a little bit tricky. So take this chart, for example, right? This is a cherry-picked time horizon, and you can clearly see that we've got the euro yen in orange, and I've got S&P in gold or yellow, and you can see a very closely correlated move. But if I pop in something like the Aussie yen, you can see a very similar correlated move. If I pop in the Kiwi yen, the CAD yen, the pound yen, some of them obviously more than others, but you can see that clear correlated move. Now, if I just quickly move this onto our recent developments, if you bought any one of the Japanese yen pairs from June in anticipation that it's going to go up alongside equities, you would have been losing money all the way to the downside, right? So let's just take euro yen as an example itself. So let's take euro yen. Even though we had a very strong correlated move from last year's lows, even though it moved very correlated, many things moved correlated and bounced purely due to the massive shock we've seen in the markets and the size of the moves we've had. Now, more recently, we've started to see yen pairs breaking down, but it's not only this recent correlation that's in focus here. If we take this at a much bigger scale, so let's just zoom this out on a Let's go to a daily here. Let's zoom this out. You can clearly see, that correlation that seemed very, very close from the bounce last year, or from the dip last year up to about June. That correlation suddenly doesn't seem so sharp anymore. And once again, it's because there will always be idiosyncratic drivers for individual currencies and currency pairs, which means that they won't always follow risk sentiment very closely, especially in the medium to long term. So again, let's hide the euro yen and take the favorite risk proxy, which is Aussie yen. Even Aussie yen, you can clearly see, there's been periods where it just didn't follow the moves that we had in equity markets, and that's because there's always going to be those idiosyncratic drivers. The one for me that I always refer back to, because I was trading Aussie yen quite a lot during that time, is the time span from around about the end of 2017 all the way up to 2019, where even though we had some sizable dips in equity markets at that time, during that time, we had a continued grind to the upside for something like the S&P, but we had a continual downtrend playing out for something like the Aussie yen. And that was, of course, really down to just two things in the broader scheme of things. Firstly, at that time, the whole global economy was going through a massive slowdown. So the global economy basically peaked at the end of 2017, started to roll over. And while that was happening, the US was actually firing on all cylinders. So you had China slowing down, you had Europe slowing down, you had the whole Asia Pac really slowing down. Everybody was slowing except the US. And that put a lot of pressure on the Aussie because of the Australian economy was slowing down, but also China, its biggest buyer, was slowing down. The global economy was slowing down. So again, as a proxy for global health, that was really bad for the Aussie. That didn't really affect the S&P too much. Again, we had blips, but the overall trend was clearly to the upside. Apart from that, we had the trade war playing out, right? So the effects that had on China and Australia, with China being the biggest export destination for Australia, means it was a double whammy for the Aussie yen, or for the Aussie dollar in general. And at that time, the markets were also expecting the RBA to move into an easing cycle. So even though, in the short term, they were correlated with trade war news. So let's say you had a very positive a trade war comment, you would see equities rally, or the Aussie yen rally alongside equities, and vice versa. If it's bad trade data or bad trade news, then you would see the Aussie yen tank alongside equities. But the broader scheme of things, the longer medium term trend wasn't really a like for like comparison, and that's because there's always going to be those idiosyncratic drivers. So part of the big jump we had to the upside in most of the yen pairs wasn't just the pro-cyclicality aspect for things like the Aussie and the Kiwi and the CAD. It was also the Japanese yen, which was expected in that recovery phase to lose ground from a safe haven point of view. So in the short term, Charles, I would say it's definitely a good proxy to use. Not necessarily the euro yen so much, but the Aussie yen, the CAD yen, the Kiwi yen is always going to be good proxies in the short term to trade for risk sentiment. So the moves we've had over the last two sessions was a good example where we saw most of the yen pairs tank, but more so on the high beta side, with the Aussie yen, Kiwi yen, CAD yen moving lower. But in the medium to longer term, I would say it's best to stick to the equity index itself, as opposed to looking at the currency pair, because there will be various different drivers at various times for the currency pair, which can be vastly different to what's driving the equity index at that time.